Hey everyone, my name is Michael and I work as an equity analyst at Simply Wall Street. So this week we're looking into Netflix, and now while it's very well known today, it wasn't as well known back in 1997 when it first launched. So back then it was a DVD mail order rental sort of business, and it changed that model back in 2007 when it launched the Watch Now service, which is what we know today as its streaming service. So our piece this week looks into a few things. First off, we cover the strategy that the company used to get to the huge scale that it has today. We also looked at what the company is doing in terms of strategies to maintain its lead that it has. And then we also look into basically how this is converting into profitability for the company, because originally when it first started, it wasn't very profitable, but as of late, it's actually been able to turn that into some profits. So that's what we looked into in this week's piece. As we all know, Netflix is a streaming service for content, and its strategy from day one was quite simple. Pretty much grow its subscriber base as quickly as possible by serving other people's content through an enjoyable user experience. And then once it had enough scale and was bringing in enough money, start producing its own content. And that's pretty much exactly what Netflix has done. Earlier on, they were a distributor of the content rather than being a producer. So they basically licensed all of their content from other studios, and that's because they didn't have any of their own. And that's basically, that model's fine early on, but it can bring with it some risks. So the main risk pretty much is that you're at the mercy of these studios where they can withdraw their content pretty much at any time, and that leaves Netflix very, very vulnerable. So Netflix was a distributor at the start, and that kind of model really doesn't favor distributors. Before Netflix had scale, that kind of model favors the producers much more than the distributors. So Netflix knew it had to get scale as quickly as possible so that it could start producing its own content. And by 2013, that's exactly what it did, where they've produced their first original. And many of you have probably heard of it, but it was House of Cards, the award-winning TV show. And from there, they've pretty much continued to do that. So they've continued to spend money on building and creating their own content and their own originals, because that's a way to become less reliant on the studios. So nowadays, they have around 1,500 originals out of their library of like 15,000 titles. So it's around 10% of their content so far. And basically they knew that that was the way for them to build differentiation and build scale. And we've pretty much seen that play out. So now that Netflix has a huge lead in terms of their 204 million subscriber base, the challenge for Netflix is to maintain that lead. And Netflix knows that it has to do that through creating its own content. And we can actually see some evidence of that in the company's financials. So we'll dig into that now. Now, it's one thing to generate a lead like Netflix has, but it's a whole other ball game in order to maintain that lead. And that's simply just because there's so many different streaming options out there that users are spoiled for choice. So Netflix knows that in order to remain competitive, it needs to produce its own content. And that's exactly what it's been doing. But the thing is, content ain't cheap. So for the year 2020, Netflix spent $15 billion on its cost of revenue, or that was about 61% of its revenue. Now, of that $15 billion, about $10.8 billion was classified as the amortization of its content assets. Now, amortization is just a method for writing off the cost of the content over its useful life. So Netflix also said that on average, about 90% of their content assets are written off or amortized over a period of 4 years. So as an example, if Netflix was to, say, agree to a $100 million licensing fee with a studio, rather than incurring that $100 million up front, they would amortize that content, that spend at $25 million per year over a period of 4 years. Now, that's just on average. It could be more sometimes, it could be less sometimes, but that's pretty much just to give you an idea. Now, this chart here shows the amortization charges have increased year over year since 2013. And that makes sense because the company's been spending aggressively on its content. Now, what you'll notice though is that there is a cash spend column, and that cash spend column basically reflects the company's spend on actual content at the time. So what you'll see here is that actually it's increasing at a faster rate than amortization. And you may be wondering why. And that's just because the company has been spending more money on producing its own original content. And that's because when you produce your own content in-house, you spend more money up front. So you have to pay the talent, you have to pay the directors, you have to pay all the costs up front that are involved with producing a film or a TV show, rather than having the ability to, say, pay it off over a period of time. Now we can see basically evidence of that cash spend that then shows up in the balance sheet. So in 2016, the company had about $11 billion in content assets, and 86% of that was licensed content. So it was primarily from other studios, and 14% was produced content, so in-house. But by 2020, that really changed, and it was basically almost even, where the content assets had now risen to $25 billion, but the split was much more even, where it was 54% licensed content and 46% produced content. So that basically is just helping the company to increase its moat, because as mentioned earlier, its spend on original content is helping it build its differentiation from others. So those originals are pretty much the likes of The Witcher or The Queen's Gambit or The Crown or House of Cards, or used to be House of Cards, because I don't think it's on there anymore. And it's basically those are the kind of pieces of content that you can't find anywhere else. So it's unique to Netflix, and basically that kind of having those unique originals helps Netflix retain and acquire users. So it's sort of like a flywheel, basically, where the more scale Netflix has, the more originals it can produce, and the more originals it can produce, the more unique it becomes from it separates itself from its competitors. And the more it separates itself from competitors, the more it entices users to sign up, because it has stuff they can't find anywhere else. And the more users that sign up, the more scale it has, and so on and so on. And that flywheel just keeps going around. So Netflix has done something really clever, where it was originally the distributor of the content, and now it basically is the distributor and producer of the content, which has given it much more control of the supply chain. And as a result, that basically has given the company a lot of operating leverage. And we've seen that basically show up in the company's profitability. So we'll look at that now. I've actually had to turn the lights on here because it's getting a bit dark. But anyway, we'll continue. So as for a business like Netflix achieving profitability, the key is scale. So we've seen that happen over the last 5 years, that as it's increased its scale, it's increased its profitability, and analysts expect that sort of trend to continue for the next 5 years too. So back in 2016, the company's net margins were only like 2.1%, but by 2020 year end, they were 11%, which is quite a big increase. And that's mostly in part thanks to its huge increase in subscribers, which was about 120% increase to the 204 million we've seen more recently. So as for the next 5 years, analysts expect pretty much more of the same. So they expect revenue to reach 51 billion and for net income to reach 12 billion. And that would be pretty much a fourfold increase. And with those kind of numbers, that means their net margins would expand even further to 23.5%. Now, it's important to note that those forecasts assume that Netflix continues to increase its scale and also continues to increase its investment in its own original content, because that original content is more of a fixed cost expense, and the licensing fees are more variable and continuing. So once Netflix has made an original that cost $200 million, basically it has that content and that asset for the rest of its life. So if someone's still watching it 3 or 4 years later, Netflix is still making money off that fixed cost. But if someone is still watching their licensed content later on, Netflix is still paying for it. And it should be noted that while Netflix needs to continue to make its own original content, it's actually got the scale now where this is much more affordable than it was back in the day. So it's also interesting because that kind of situation they're in right now gives them leverage over the studios, when that just wasn't the case back in the day. So if studios wanted to withdraw their content and make their own streaming service, which some of them have, like Disney, they would have to start from square one and grow their subscriber base incredibly quickly to make it at least as economical as the fees that Netflix was paying them. And if they didn't want to start their own streaming service, they basically have to try and go and find another streaming provider that's willing to pay them more than what Netflix is paying. Now that might be hard because Netflix is the biggest streaming service out there, and therefore also has the deepest pockets. So basically Netflix now has a bit of operating leverage over the studios. Back in the day, it just didn't have that. Now it does because it has that scale. So it's a very important point to note. Basically, those studios would find it very hard to turn away the big money that Netflix is willing to pay them. So to sum it all up, Netflix's core focus for a very long time has been on subscriber growth, since it knows that's been the key to its profitability. And since then, it's been investing in originals, which has also benefited it in many ways. So having more originals helps it retain existing users, acquire new users, and build differentiation from its competitors, and then also expand the company's margins, as we mentioned earlier. So as Netflix begins to own more of the supply chain by becoming both the distributor and producer to its users, it helps expand the company's profitability and margins, which is key for a business like Netflix to do well. So we've seen this happen in the last 5 years, and analysts, as we mentioned, expect it to happen for the next 5 as well. So while streaming wars are heating up, Netflix is in a very good position to remain competitive and to hold its own. So if you'd like to read the full article, we'll have a link below. And if you'd like to check out the full company report for Netflix, you can check out our platform. And that's pretty much all for this week. So thank you so much for watching, and we'll see you next time.